Welcome to today's episode of the Simply Financial Podcast. This is episode number 29 of season 4, and I'm your host, Christopher Calandra. So my guest today is a frequent guest of the Simply Financial Podcast. Dean Nicholson has been on the show many, many times before, and regular listeners will remember that he was in the financial services industry for most of his career. He considers himself an economist. He retired several years ago. In fact, I acquired his business, and we still work closely together today, not as close as we used to because he's enjoying the wonderful retirement life that he is entitled to. But we check in with one another regularly. I like to talk about the economy and the markets from a macro level with him. We do so routinely. And now that we're just past the mid-year part of what has been a crazy 2020, I thought it would be wonderful for him and I to talk a little bit about what is going on. So, Dean, I appreciate you joining me today.
Well, I welcome the opportunity.
So I gave a webinar exclusively for clients last week, and I opened it up with a quote. It's from Vladimir Lenin. I'm not a huge fan of Vladimir Lenin's, but it is a very appropriate quote. It says, "There are decades where nothing happens, and there are weeks where decades happen." And I've thought a lot about this quote relative to what's happened in the United States as well as the world with the pandemic and the shutdown and everything that's going on related to those two big items. And I really feel that the last couple of months have been one of those episodes that Lenin was referring to where so much is happening and the reverberations of all that's going on right now will be very impactful for many years to come. Do you agree with that sentiment?
Absolutely. I've been in business so long, you see things happen overnight that change things dramatically. So I couldn't agree with that more.
Yeah, and I think this pertains, we're going to talk finance and the markets and the economy, but I think this also relates to things outside of that scope, like education, consumer behavior, politics, our healthcare system. I just think this is far-reaching in how things are going to change over not just the next couple of weeks and months, but for years to come. So I like that quote a lot. Again, I'm not endorsing Vladimir Lenin, and I imagine you won't. So, let's just review. This is some of the topics that I discussed exclusively for my clients last week. The first half of 2020 was crazy, right? We had a huge sell-off, deep sell-off, market rally, still dealing with the pandemic. I would like your thoughts, not that either one of us are scientists or healthcare professionals, but, it seems pretty likely that the pandemic is stubborn at the very least, is going to be around for quite a while. I imagine we could debate whether we're going to see significant spikes in deaths and hospitalizations in certain parts of the country, or if it's just kind of be this stubborn, regular issue that we have to deal with in terms of positive tests, some hospitalizations, but the system not being overrun, and some deaths, but maybe not like we saw at the height where New York and New Jersey, for example, are, I think they're 30 to 40% of the overall deaths in the whole country. But you think that's a pretty good description of it? How would you frame what is going on with the pandemic now and thinking about what might happen as we finish up 2020?
Well, you have an analogy. If we can put men on the moon, we can solve this virus problem over time. It's not going to happen overnight, but I think it's eventually you're going to get a vaccine, and this is going to be just like another flu that we've been familiar with for years. But it's going to affect the economy for another 12 to 18 months as a minimum. But that being said, I think it is going to convert back to the reality of how our capitalistic system works. So I think it's not a death knell for capitalism or the economy. It's just going to be something that is going to lag on for probably a year minimum.
So I don't want to open up a can of worms, but I do want to touch on this a bit. I was with some friends this weekend, social distancing, but a lot of what I've read in the media, the economic and financial part of the media, often point to, if we could get a vaccine, it'll be a great event. And I don't disagree with that. But what troubles me is I can see a very likely scenario. I would almost bet in favor of the following happening, is that a lot of people in this country, for a variety of reasons, I think some legitimate, some illegitimate, are not going to be too keen on rushing out to get the vaccine. So the vaccine in and of itself is a Herculean effort. It has to be developed, and it has to be manufactured and then distributed to the American population, which is large, but also the population around the world. That's a big, big task. But additionally, I think a lot of Americans are going to be reluctant to take the vaccine, especially early on. Some people, Dean, it seems to me, a certain amount of Americans are just, well, if you make me do it, I don't want to do it. I think it's just sort of in the DNA of a lot of Americans. Just they don't like being told what to do. I have a certain strain of that myself. I think still others will say, well, look, this vaccine came to market much quicker than any other vaccine in history. And some people might say, well, look, I'm healthy. My family's healthy. I'm not in a high-risk category. I either didn't have it or had it and was asymptomatic. Why would I want to rush out and get the vaccine? I think there's going to be a lot of people in other vaccines. There's a certain percentage of the population that don't want to take it for concerns over other health consequences, side effects, that kind of thing. And so all of this means that I think that the country might be in for another battle about those that want to take the vaccine and think everyone should take the vaccine, and those who either don't want to take it right away or don't want to be compelled to take it at all. And just to, I know I'm being wordy, but you extend that out, what are you going to do with that? Are people that refuse to take the vaccine, are they not going to be allowed to go to their corporate jobs? Are they not going to be allowed in school? Will a police officer not be able to go to their shift? You're not going to be able to go on college campus? Is it going to be that rigid? I think this plays out to a whole nother big battle when the vaccine comes, which is going to be another example of a lot of uncertainty. I know I was, again, on my soapbox, Dean. Sorry. Thank you. I'm glad it's my show and I'm able to do that. But what do you think?
Well, yeah, and added to the complication, you have governors and mayors that are putting edicts and changes to the CDC recommendations. So you're going to have like 50 different economies instead of one economy, because depending upon how strict or how liberal some governor is going to affect the growth of the economy. But that being said, you still have to house, feed, clothe, and give services to all the citizens in the United States, regardless of what their risk tolerance is. And so as an investor, you sit back and say, our capitalist economy works if I use your expertise and monitor it and make changes where necessary. I wouldn't get out of the market because this is going to happen. It just means that your services are that much more valuable because things are going to change. And you shouldn't try to make money on short-term changes, because that's not investing. That's speculating. That being said, you have to be realistic.
I would just caution people. I've spoken to some investors that say, I'm not going to do X until we get a vaccine, or the attitude of it's going to be tough until we get to the vaccine. And I think the vaccine is a very important marker, and I hope we get there sooner rather than later. But that would be, to me, akin to stop running the race before you get to the finish line. I don't think that is the finish line. I think it then sets up a whole new set of things that politicians and the healthcare professionals around the world have to deal with. So in that sense, it's something to bear in mind, because we're not going to go back to what we knew as normal when the vaccine comes. Some people might be holding out hope that that's the case. So Thank you for humoring me on that tangent. So let's talk about the economy. We're waiting for Q2 economic numbers to come out. Clearly, the numbers are going to be bad. I think everybody accepts that, has digested that, and the markets and most economists and watchers of such things have kept an eye farther down the road as to what happens next. So what do you think? Do you believe, based on what you know now, and this is just your opinion, you don't have a crystal ball any more than I do, but do you think the recession will last more than 2 quarters? We had negative GDP growth in Q1. We're going to have negative GDP in Q2. Do you believe that we're likely to have GDP growth be negative in Q3?
No, and the reason I don't, I hate to bring politics back into this, but it's part of the formula. You have an election coming up, and politicians buy votes. So they're going to be spending money. They are going to try to spend money, or they're going to talk about spending money. And you have to understand that the market acts in anticipation. It doesn't. Professional investors and serious people in the market are always projecting what they think is going to happen. And so whether you're a Republican or a Democrat, what's going to happen? The government's going to be spending a lot more money. Whether the unemployment is extended or not, it doesn't matter. The government's going to be spending a lot more money to protect the economy. And because of that, you're not going to have a long-term recession. You can't, because they got to buy votes. So they got to talk about spending money or spend money. And that's going to force us out of the recession whether we wanted it or not. Now, the national debt for our kids is going to be unbelievable, but as a reasonable investor in retirement, they're going to kick that can down the road for another decade. So I wouldn't be too concerned about the market. I think the market's going to take care of itself.
So in summary, your position is that in Q3, because of the looming presidential election, and I think other factors too, that the government will pull out all the stops so that we don't have a negative growth rate in Q3. So you think the odds are stacked in favor of Q3 being some type of rebound quarter?
Absolutely.
Okay.
That's exactly correct.
All right.
Now, of course, I'm a human being and I could be absolutely wrong, but I don't think so. I think that's what's going to happen.
No, I think so, and I'll add on to what you said is that, this deep negative number we're going to get for Q2 was because of the really, really dark expectations about COVID and the economic shutdown, and things are bad now, and they're very troublesome. The pandemic is stubborn in some places. As of the recording of this, the positive test cases are on the rise. There's a lot of uncertainty and troubling aspects of this. But in March, they were estimating 1 million, 2 million, 800,000 Americans dying, and it doesn't seem like those worst case scenarios are going to play out. That means that the economy is not going to be shut down and shut down as rigidly as it would be if we had 1 million deaths in the U.S. It's hard to even fathom where we would be if we were on pace for that kind of carnage in the U.S. So businesses have been able to open up. Consumers have been able to go about their business. Now, things have changed. They certainly have, and certain industries have been harder hit than others. But I think that there's enough activity with the opening of the economy and the pandemic not being as bad as originally feared, although still bad, that gets us to Q3 having positive economic growth.
I agree completely.
Given where the market is today and looking about what's happened and where we think we might be with the pandemic and quote-unquote the new normal, do you have concerns that the market might have moved too far, too fast, given the backdrop?
Well, I am in a way, and that's where you come in. I'm not trying to, encourage people to bow down and, to you. But basically, that's what diversification is all about. As you know, during the recovery, certain stocks went up like crazy, like Amazon and Netflix or whatever, because people were forced into their houses, and they were going to use it, so people bought them, saying, "Oh, great! I can make some money here." All right, so they jump into there, but that's not the way he should do it. All right, the fact is, you take a look at, as an investor, you should be looking at what's happening with the gross national product, and the gross national product consists of consumer spending, business investment, and governmental spending. As long as those things are up, overall the market is going to have to go up because it's going to be dragged up because of the spending of consumer and business investments and government spending. So that being said, yes, but I wouldn't get out of the market. It would be a mistake, I think, to reposition into cash, because where can you go? Normally you go into bonds, but bonds are ridiculous. They don't even keep up taxes and inflation, so you can't do that. So can you go back into cash? Well, you could, but that's where you have to be careful of trying to pick the sectors where you're going to get out of. If you haven't got out of the airlines and the hotel, and retail markets, it's too late. You should have got out a long time ago. But sure. I wouldn't make any large term changes in my investment portfolio unless I needed cash. If I need cash in the next 6 months, yeah, maybe I would.
Sure. Yeah.
If I needed to some cash.
You mentioned bonds. I mean, yields are ultra low. Interest rates are ultra low.
Right.
Where does that? I mean, because we joke, you and I. I mean, you have a few years on me, and for a long time now, the trend of interest rates has been declining. You go back to the early 80s when you had interest rates at 18, 20%, whatever, and they've come down and down and down and down after 9/11 and the tech wreck.
Right.
They came down further. And then, they bounced around a little bit, and then after the financial crisis, they came down. Started going up a little bit in 16, 17, and 2018, only to go down now and create new lows. But we're almost at zero now.
Right.
Again, I have a few years on you. Am I going to see negative interest rates in my lifetime in the U.S.?
You won't see negative, but you're not going to see increasing interest rates for quite some time, which means you really should stay away from bonds, because anytime an interest rate goes up after you buy a bond, regardless of how strong the credit rating is of that bond, if you try to sell it, you're going to lose money. Yeah. So I wouldn't be an interest rate investor right now. The only place you could get any type of yield is in real estate leases with necessary corporations on corners of large intersections, and that sell pharmaceutical products or something. Yeah. So forget bonds. I mean, I shouldn't say it, be more professional.
No, I know what you mean. Because historically you would use bonds, in conjunction with stocks. And we're not saying you wouldn't do that, but what we are saying, because I agree with you, is that you got to look at bonds much differently today. And looking at a 10-year investment history for a bond fund or a bond position is nothing wrong with it. But you also have to really think about how much different it is now than 10, 15, 20 years ago, because interest rates are at zero now. And that makes it a fundamentally different environment than it was in episodes past. And bonds are really tricky right now, and people ought to be careful with bonds because they're not the same animal as they were before. And so your opinion is now, because I know we had talked a few years ago, I was in the camp that thought that we were entering into a phase beginning in late 2016, that we were in a rising interest rate environment, and that period would last for quite a while. It would be a multi-year trend with interest rates gradually increasing. And that seemed very likely in 2017 and 2018, but that changed at the end of 2018. And might have restarted again, but now with the pandemic, I think that's completely old news. I would imagine we're going to have very low interest rates for 3 to 5 years before we see interest rates going up, and that's just a guess. And that's all subject to change, right, because we live in a very fluid environment. But I don't see bond yields going back up to even where they were in say mid-2018 anytime soon. What do you think?
Well, I agree with that, but an added complication is that a lot of people look at interest rates for mortgages and homes is versus the interest rate for bonds. It's like in a different aisle of the shopping market. Now, ironically, because of this coronavirus, there are a lot of mortgages that are being defaulted on, and a lot of rental payments aren't being made. In bank interest rates are probably going to go up. Even though bond interest rates aren't, bank interest rates are, because they have to hedge and put aside a certain amount for bad loans. So that's another complicating factor. So you got to be careful of that too. And I don't know, I haven't gone through as an economist this type of reaction in what happens with actually bank interest rates. So I'm going to be interested to watch to see what does actually happen to them.
No, you bring in a great point, because banks, for their own good, may influence mortgage rates and borrowing rates given the high unemployment and the disruption many families have had and will have, means that they may not be able to pay on their loans. So the banks consider that in their pricing. And I mentioned unemployment. Unemployment skyrocketed to ultra high levels. It's come down some, and it will come down. But we got to unemployment of 3.5, 3.6 before the pandemic walloped the economy. Yeah. How long before I see 3.5, 3.6 again? Long time, right?
Yeah, it's going to be a long time. But it's not going to go super high either, though, so you have to pay attention to what you're doing. And as, a retiree, I pay attention to my own investments. But for most retirees, they don't spend as much time as you and I look at the market, and that's why your service is that much more value. You got to look at all this stuff and make some judgments on the short term that I'm not going to be making. I'm just buying and holding, because I believe as an economist that our economy will work. But my time frame for needing income is maybe longer than some of your clients, so you got to be careful.
Yeah. So we're in agreement that unemployment's high, but it's abnormally high. When I say abnormally, a lot of it, or a portion of it, will quickly work itself through. Then the question is, what do you do with the balance? Let's say we go from 12 or 13 to 8 in short order. How do you get from 8 back down to 4 is going to be the tricky part of, our economic system, helped by some hopefully good decisions with our politicians, both nationally and locally, because that, I think, is going to be the tricky part. Some of it's going to be easy, but that stubborn part, I keep saying stubborn, that stubborn part is still going to be there, because some industries, some businesses are just not going to recover to what they were before. And, of course, there'll be other businesses and other industries that will be created, but how you get the unemployed people from where they are to where they need to be is always the tricky part.
Absolutely. And it's also a question of how much national debt can you afford to take on, for unemployment benefits to try to keep consumer spending up. That's another factor you got to consider. So nothing's easy. Nothing is easy. I wanted to get your thoughts as we begin to kind of wrap up, but, two topics. One is gold prices. Now, I'm traditionally not a gold investor personally, as well as with clients, but I have used it successfully in my practice before, that being in the 2009, 2010 period, and it was successful. I'm thinking about gold a little bit, using the playbook from the great financial crisis. You mentioned how the government spent a lot of money, and you made the point that the government's going to spend a lot of money. And we say spend. You could use different terms, right? Because print money, the Fed expands its balance sheets. There's lots of different terms. But the point is the government and the Fed, they're putting a lot of money out on the street, creating a lot of liquidity to help the economy get through this period. And I want your opinion, because I know you're not a gold guy, how you would look at gold relative to where we are now and where we might be going. Very good point, because basically gold is almost going to have to take the place of bonds to a certain extent. Being fully aware that gold can be even more volatile. But you can't use bonds anymore. So when I first got in the business, you had stocks or equities, you had bonds. And you retired when you're 67 and you were dead by the time you were 74. So you'd sell all your stocks and just buy a bunch of bonds until you died. Okay, you can't do that anymore. But the market is not a place where you can really count on what's happening because of all the uncertainties we've just discussed for the past half hour. So my attitude to gold has changed because of the weakness of bonds.
Sure. So you view gold differently than you did 10 years ago for the same reason that I described. You got to look at bonds differently than 10 years ago because the landscape has changed so dramatically that gold might be, and of course, everyone that's listening, these are Dean's opinions. These are my opinions. You should not go and do anything specifically because of what we are saying. You need to do your research, talk to your professionals. Hopefully, if you're a client of ours, you'll check in with us. And if you're not a client of ours, we would love for you to check in with us. We're just talking at a high level, not giving any personal advice. But perhaps gold is an appropriate substitute in whole or in part for bonds. And I find it interesting that gold has been rising. It's at an 8-year high. It's had a good year so far. It's making its way higher, not explosively, but I think that, and I haven't worked this all out, and I'm not 100% committed to this position yet, but gold has very long periods of time where it's a lousy investment. If you would have invested in like 1980, from 1980 to 2005, it was a terrible investment. You lost money. But then it has paired with that other periods where it goes higher in a very strong move in a relatively short period of time. Within a few years, it could make very strong movements. I'm sensing that we might, again, emphasis on might, be entering into one of those phases in part because of the trouble with bonds, in part because of all of this money that the government is throwing at the problem, that gold has a tendency to prosper in those kind of environments. But I'm not really a gold guy traditionally. I know you aren't. I did use it successfully back in that 2009, 2011 period, but it's something I'm taking a close look at. But you would be open to taking a close look at that, where, as in the past, Dean, you might have not paid as much attention. Is that fair?
Absolutely, but you got to be careful. As you know, there are many different ways to invest in gold, so you got to do your due diligence and look at these different ways of investing in gold. Even if you can get burnt, even if you pick the right direction of gold, if you're not careful, because there's a lot of false claims made by some of these people that sell gold IRAs and things like that. Be careful there.
You bring up a good point. Yeah. Definitely buyer beware in that marketplace for sure. The last thing I wanted to bring up with you, and you touched on presidential election, and the market is not very focused on the presidential election now. It is certainly has enough on its plate with everything else going on. But, we are, as of this recording, in the latter part of July, and that means that the presidential election is only a few short months away. It seems to be another one of these very big elections. I thought 2016 was as well. And it's a challenging thing because I talk with, we have a very diverse list of clients. I talk to some clients that are pretty apolitical. I talk to others that are very oriented to one side or the other. And my clients are educated. They're smart. They're worldly. They have strong opinions. Many of them are executives and successful small business owners or retired successful business people. And the opinions are all over the map. How would you look at the presidential election as it relates to, all the decisions we need to make the next couple of months about how to invest, how to position, how much risk to take, what's in favor, what's not in favor? There's a lot, so it's a very loaded question, but the presidential election has to factor into it at least to some degree, no?
It does, but you got to be careful. As an economist, again, I'll go back to my gross national product, and it consists of consumer spending, business investment, and governmental spending. When Democrats are in, the governmental spending goes crazy because all the social things that they do. Business investment usually goes down, but consumer spending still goes up because it's a wealth transfer from the rich to the poor, and the poor spend more money than the rich. Okay, so that's what happens if Democrats get elected. Now, when Republicans get elected, what happens, business investment goes up, governmental spending may go up a little bit, but not that much, but because they try to make the consumer, again, powerful because of making businesses and increasing employment. That's what Trump is after, is more employment, which means more money and more consumer spending. So they're both going to try to target consumer spending. So actually, the election is somewhat neutral politically. So don't sell all your stocks because you hear that Trump is going to lose. And I wouldn't buy stock because you love Biden because that's not going to really affect it that much either. So you have to be kind of neutral on the election, honestly. But don't invest politically. It's the fastest way to lose money, and don't do it. It's not going to work.
I would agree with you, and I've long said, as you have, because you've seen the data too, that trying to make big-time investment decisions based on the outcome of a presidential election is dicey at best. It does concern me a little bit, and I might be biased, because for those of you listening, you know, I'm much more of a Trump guy than a Biden guy, and it's not to say I endorse everything that Donald Trump does or dislike everything that Joe Biden stands for, but here's one thought that I have been bouncing around in my head is that we have so much uncertainty going on and so much change going on as Americans try and work their way through this pandemic and the aftermath economically, that if you have a change of leadership in November, I know the election's in November, but Joe Biden would then be sworn in January, is this might not be such a great time to really change dramatically the direction of the federal government. Because right now, President Trump, for all of his faults, and there are many, you kind of know what you're getting. You know what you're getting on tax policy, on the regulatory front, on the rhetoric front. You kind of know what it is. And businesses now have had to make calculations on how they want to deal with what the federal government is doing. And Americans have had to do the same thing. And now if you have a significant change with Joe Biden becoming president, it's like one more whole set because almost everything is going to change. Rhetoric, policy, regulatory environment, all of those things. And maybe some change is needed. I'm not saying that at this point. What do you think, though, about we already have a lot of change. Maybe it's better that President Trump wins. Not that we're endorsing anybody, but that President Trump wins just because we kind of know what we're getting and the economy has enough to try and digest already that continuity would be helpful. Can you share your thoughts about that thinking?
Well, as an old guy who's watched human nature for 70-plus years, people don't like change. They don't like change. So even if you go in from bad to worse or worse to best or from good to better or better to superior, any change is going to have somewhat of a negative effect. So your statement is well taken. Any change is going to be somewhat disruptive. So all that said, if you avoid change, things will be much more easy to project results than when things are changing. So,
yes. So I mean, if I was consulting for Donald Trump, which would never, ever happen in a million years, you know, I would say, look, we built a great economy. The pandemic messed everything up, but, you know, we could build it back again together. It would be some type of messaging because the economy was very strong before the pandemic. Not perfect, but very strong. Unemployment was strong. Economic growth was strong. U.S. businesses were very competitive against their peers around the world. So I think that would be pretty good. And of course, Joe Biden, who wants to be president, is going to say the economy is a mess. There's a lot of truth in that. And what we need is a change because we need new leadership, new thinking that will help the economy get back on its feet again. And that's, a pretty good argument. Of course, the devil is always going to be in the details of how you carry that out. But that's what I would say to both of them if I was consulting, and that'll never happen. That's fantasy land. But should be very interesting. And I think the market before too long will begin at least peeking an eye at what's happened with this presidential election and what the candidates are putting forth in terms of a prescription for the economy and how they would want to run the country if they actually won the election and got the job. So, Dean, thank you very, very much. I always enjoy our discussions. Really, really good stuff. Anything else you want to say in closing?
No, I'm just encouraging people to talk to their financial advisor whenever they hear something that's disturbing to get the real reality. Do not trust what you see in the media. That's a horrific mistake. Don't do that.
Yeah, that is, you just teed something up for me. The media, their job is not to help you make good financial decisions, never was,
No.
Especially is not true today. So be very, very cautious about that, because you're not necessarily getting all the information, and you're not getting the information really in a way that is meant to help you make informed decisions, and likely leads to making emotional decisions, which often are ones that you will come to regret. So I'm 100% in favor of what you just said. Thanks again, Dean. You think in a few months you'll come back and we could see how this year continues to unfold?
Oh, absolutely. You help me with my investments just by talking to you. I also, project what I should be doing as what I'm not doing, and so love it. Not
Beautiful.
a problem.
And thank you, listeners, for joining Dean and I today. Please subscribe to the Simply Financial podcast if you haven't already. Also, go to our website, www.elliottwealth.com. Completely revamped the website. It's awesome. If you haven't seen the updated version, please check it out. If you're not a client at the site, please sign up for a complimentary consultation. We'd love to talk to you and discuss how we can help you win with money. Thanks again, Dean. And listeners, I will be back with you on the next episode of the Simply Financial podcast very soon.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.